Hello and welcome to Bitcoin and Gold in 2024. My name is Charlie Morris, founder of ByteTree, and it's my pleasure to be joined by Jan Nieuwenhuij from Gainesville Coins. But actually, Jan doesn't live in Gainesville, wherever that is. He actually lives in the Caribbean. How are you, Jan?
I'm excellent. Weather was nice here.
And most people with that sort of background, for their Zoom, it's a fake sort of still picture, isn't it? For you, it's real.
Yeah, this is real. Yeah, I used to live in Amsterdam, but I moved to Bonaire. It's a little island in the Caribbean. It's kind of like a province of the Netherlands, so it's not really a problem to come and live here. And yeah, I really like it. Now, this is my rental place now, and this is the garden.
And so tell us about your background in gold. You came to the gold market after 2008. You were inspired by the credit crisis and you got interested in money, as many people do. So just tell us about that.
Yeah, I'm really a product of the great financial crisis. So I was a sound engineer for movies before that. And in 2008 and especially 2009, the crisis really struck hard in the Netherlands, and there was just nothing to do in the movie industry. There's no movies, no advertisements, no series, nothing was no work. So I started to think about, how did this become? I didn't change anything in my work, and why did the entire industry dry up? So I started reading books, and of course, if you pick up also at the time you had zero hedge and whatever, and I was kind of drawn to towards gold, and so I had a hobby. I was eventually the movie industry picked up, but I started reading more and more books about economics, and in what was it? I think 2013, I got a knee surgery, and then so I was homebound, and I spent some more time on the internet reading more. And someone on Twitter actually told me about withdrawals from the Shanghai Gold Exchange. And at that time, nobody knew in the English-speaking world, or there was no one writing about it. So, and he told me about the Chinese website where all the juicy information is. And, it was an open conversation, so everybody could notice. But so I went to the STE website, and I called them the next day, and the numbers on that website really were about how much gold was being withdrawn from the vaults of the Shanghai Gold Exchange, the SGE. So I started a blog, and on the blog I wrote that SGE withdrawals basically are a proxy for Chinese wholesale demand, and everybody's laughing at me, and no, that can't be, it's too much gold, and blah blah blah. And then there was an LBMA conference, and the president of the SGE actually confirmed what I had been writing. And then I was offered a job at a bullion dealer in Singapore, and I worked for them for a couple of years, I guess. Yeah. And I worked for a bullion dealer I changed jobs, obviously, because, I thought, how cool is it to just, do something else? I worked for a bullion dealer in Finland for a while, and now for Gainesville Coins in Florida. So
Fantastic. All nice places. So welcome. Yeah. And let's change slides. This is what happens, isn't it? It didn't happen last time as well. Yeah, there's a disclaimer saying nothing to do with this is anything to do with gold or anything resembling gold. Here at ByteTree, we write research. We have a gold report, which Jan is sometimes featured in. We also talk about Bitcoin and traditional assets. And I write the multi-asset investor and venture, which is small and mid cap, basically special situations. Okay, first up, a slightly manipulated chart, of course, because it starts in the first 2000. But this century, it was nearly 25 years. Gold is still ahead of the S&P 500, including dividends. And not many people know that. So it's an extraordinary time. And of course, the first 3 years of the century, the S&P was under pressure. It also had a credit crisis in 2008. But there again, gold also had its own bear market in 2013, 14, 15. So, but it's a remarkable situation that we talk about the S&P being having done so well over the last 20 years or so, and gold's still ahead. Now, it goes without saying, in the 80s and 90s, it was the other way around. And gold went down quite a lot, and the S&P went up. But over long periods of time in history, this is a relationship that matters. So what happened recently was the all-time high in the gold price. So it's happened in all currencies. That red one's the yen, which has just topped over because we just had some strength there. But really, it's pretty compelling that the August 2020 high has been beaten right across the board. And so we're now into new territory. Exciting times, Jan.
Definitely, yeah. New all-time highs. I think we're going for a multi-year bull market now, because the world has changed. It was already, there was so much debt in the system, and on the monetary field, I was already kind of bullish since, let's say, 2018. But now we also have geopolitical tensions, and that makes it, I mean, gold is a currency without counterparty risk, and I think that's very important now in the global world. I think, in the past 100 years, if you look at the relationship between money without counterparty risk, that's gold, and money with counterparty risk, so credit assets, more and more credit assets have been, invented. Bank deposits, equity, bonds, derivatives, everything. So that whole relationship, if you draw it in a chart, we're at the bottom now, actually, between the ratio of credit assets and gold. It's just starting to lift off. Gold is gaining some more share in that. And but it has a long way to go. If you look at historical averages, it can easily triple.
I quite agree.
In my
Yeah. So one of the recent things that we've been talking about has been the impending rate cuts. The gold market's been excited. Now, we're going to come on to this later, but there's been an east-west pull, sort of who controls the gold price, and this is Jan's specialist field. But over the last 20 years until recently, it was very much a dollar game until pre-Ukraine invasion. And, the big rate cut cycles really triggered off gold bull rallies. And we're about to have another series of rate cuts, seems likely. They're kind of suggesting this. And so that's one of the reasons why we're seeing gold strength at the moment. There are other reasons too. I also want to cover a little bit of the macro. We've got the bond yields, so the 10-year bond yields around the world. They've been going up, which is it's been interesting. You would have expected under the American dollar model, gold model, of that to put downward pressure on the gold price. But actually, all it did was just stop the gold price from going up. It so seems, which is now happening. And it does seem that rates have peaked for the time being. Those top two are the UK and the US, and the next one, the purple one, is Germany. And then we've got the only one going up really is Japan in green, and then we've got China coming down, which is where probably the biggest economic problems are here right now. But basically, we've got peak bond yields, and so that's a sort of pretty positive factor for gold.
Also, if it's maybe interesting, sorry, if you draw a chart from the 1970s, you also see long-term rates go up together with the price of gold. So, it doesn't have to be a drag on the price of gold.
Absolutely, because the inflation comes into it as well. Now, what we see here is the break-even rate, the expected inflation in the UK, blue at the top. Now, it's actually between 1 and 1.4% overstated, because it's actually set against RPI rather than CPI. That's a technicality, so it would be more similar to the black and the purple, which is the Americas and the Eurozone. And then, of course, we've got Japan, where it's been steadily rising from a period of deflation into somewhere more normal territory. And of course, the difference between bond yields and break evens is the real yield. And that's the important point here. And gold under the old dollar model would have gone down when real yields are rising, as they were in 21, 22, but they didn't. And I think one of the simple explanations for that is just gold's relevance in the world is becoming more important in a sort of periodic repricing. And I think that's something we have to take very, very seriously. It sort of makes sense, for gold to have such a small share of the global money supply and asset base and so forth, when clearly there's so much debt and no one really knows how that's going to end. So the need for an alternative is important. Now I'm going to bring you in on the next one, Jan. So we've now got the money supply. This is the US money supply going back to 1960. That's the red line, and it basically grows at something like 7% per year. And it's sort of, the gold price has sort of caught up with it. Obviously, there's a well-flagged massive boom in the money supply over the pandemic, as shown by the red line. The period with the blue period is the last presidency under Donald Trump. That was pretty good for gold, and maybe, just maybe, we have another one of those. Yeah, what do you think of that?
Yeah, it could be. Last week, even from this tiny little island, all I could read about was America, and it was a crazy week. The assassination on Trump, and now Biden stepped down, or he was forced to step down. We don't know, but it looks like a really unstable country politically, also socially, and that could, you have this triangle of stability in my model. So you have social stability, political stability, and monetary stability. And if you have social stability, you get political stability, and you get monetary stability. But if you have social or political instability, that feeds into monetary instability. So, and that can be a vicious cycle that drags down an empire. I mean, obviously, the US is still the biggest economy in the world and the world's a superpower. But maybe it will not go down because of an invasion or something, would just implode from the inside. Other people, they say, well, the problems that the US has, we can see in other countries as well. And we have polarization in France and Germany or whatever. But it looks a little bit worse in the US. So yeah, it will be. I think also that's why China is buying, and especially the People's Bank of China is buying so much gold, because of this instability in the US and about the dollar.
We'll come to that. That's a couple of slides away, yeah. I know you're chomping a bit to get to China. This is the attempt to show the world money supply. So here I've taken and weighted all the money supplies from the top 20 countries and regions like the EU and so forth, put them together. And that's the red line against the dollar gold price. So it's the number of dollars equivalent created as all the countries print their money. But of course, if their currency is going down in dollar terms, then what they print can be offset by the change in the currency. So that's one of the things that confuses that situation. But basically, the red line, which can only really go back 20 years because of data limitations, but it's been growing at 7.3% per year on average since that time. Suddenly, you don't see the surge in the money supply over the pandemic that you saw just in dollar land, because actually the dollar went up so much, which offset all the printing that happened elsewhere. And on this model, very simply, back in 2011, you could argue that gold was 50% ahead of itself, and that played out. And on that same basis, gold's probably about 16% ahead of itself. But I would add that that's following a period of no printing for 3 years. So we're about to see the money supply expand. And so putting just the money supply onto some sort of a logarithmic regression line over the last 2 decades, you see that they're very much at the bottom of the range. And if you just think about what happened when the money supply was at the bottom of the range back in 2003, 4, 5 sort of thing, and as it went to the top of the range in 2011, that was pretty special time for the gold market. And equally, it was at the top of the range in 2012, 13, and came down to the bottom towards 15. So you've got these kind of long-term ideas that would be very, very supportive for the gold market. And so I guess this chart is telling us that someone in politics is going to start printing more money and in a not too distant future. And as I said, sometimes that 2021-22 surge in US money supply was very, very relevant. But for the other countries around the world that were doing the same thing, that a lot of it was offset by a strong dollar. So yeah, and do you have anything to say about the dollar and gold?
Well, you see the correlation breaking, right? I mean, the dollar is not really going down much, and gold is going up. So, and that has all to do with what you just referred to with real rates. So that's the 10-year TIPS yield, and that correlation has broken since the start of the war in Ukraine, and it all has to do with the fact that the dollar has counterparty risk, and a lot of central banks around the world, but also other institutions and people, they have assets that have counterparty risk. So, and if you don't behave, the West will take it away from you. So more focus on gold, and that's why the correlation broke, I think.
Can't disagree. And you, before the interview, you said to me, because you said, you just told everyone that you came into the gold market in sort of after 2008 and got up and running by a couple of years later. And you were saying, what was the sentiment like in the in the noughties before the crisis? And I pulled out this chart. This is the Central Fund of Canada. So it's one of the Sprott closed-ended funds, which has a discount premium mechanism. Now you can blame the ETFs as much as you like, but the ETFs came to be in 2003. And in 2003, this fund goes from a discount to a premium. It stays at a premium till 2011, which is the market peak, and then slips into a discount where it is today. I would say that this 30-year chart or 40-year chart of the discount premium of gold is a pretty good long-term sentiment indicator. But bear in mind, I think the makeup of this fund is like 2/3 gold, 1/3 silver. So it hasn't made an all-time high. It's what when I first showed it to Jan, he was in horror. He said, "God, the fees must be massive." I said, "No, it's not that. It's got some silver in it." And so I think that the most valuable thing about this chart, not being rude about Sprott or anything, I think they're great guys. I just think the most valuable thing is this long data series for the gold market sentiment.
Yeah.
I mean, does that say anything to you that we're now in a strong bull market, all-time high, and you're not really feeling the buzz around gold from the mainstream media? Or
I was just, nowadays with Twitter, it's all just so much. The price goes up, and a couple of weeks later, everyone is bullish on gold. And then the price goes down, and that's the feeling I get from X. And I was just wondering how that was before there was Twitter or social media in 2008. What were the newspapers writing? Was gold on the radar at CNBC? Because I wasn't in the financial industry then, so I was wondering how gold was being reported on by media in 2005, 6 in that era. When it went up, but drastically, and who was driving the price? But I see here, inter alia, it was the Sprott guys.
So there was, I mean, I'll tell you what happened before 2008. CNBC and Bloomberg TV were all over the gold price. I mean, it was one of their things. They were very excited by it. But it's just the financial services industry. That wasn't mainstream media. And there was no mechanism to I mean, I think some people probably watch CNBC at home, but not many people did that. Obviously financial enthusiasts, but the general public, had no idea about the gold market. And I could tell you that in 2003, late 2003, when London launched the gold ETF, it was a big deal. It was a notable newsworthy event. And then a year later, when it happened in New York, it was a very big deal and all over the financial press. So it was, it wasn't like the ByteTree Bold ETF launch where no one noticed. It was, it was a big media event. So
you had a big media event, right? You were on the exchange ringing the bell, not?
Yeah, right. I was on this exchange ringing the bell, but it wasn't a big media event. So now this is your specialist subject. So we've got a couple of slides on central banks and all the rest of it, and this is the official data for Chinese gold reserves. So Jan, what do you have to say about this?
Well, the funny thing is that, like I said in the beginning, I started off with the Chinese gold market, so with the Shanghai Gold Exchange and how the whole Chinese gold market works, and that's pretty good now to understand for understanding the global gold market, because it's very much, I see it as a east-west thing. I always frame it like that, because gold isn't a soft commodity like coffee, for example. So with coffee, you can make a supply and demand balance, and any residual, so that be a surplus or deficit, indicates where the price is going. But with gold, it's impossible to do that, because it's a currency. So you can't measure all supply and demand because there's so much above ground gold changing hands, which is also influencing the price. So so instead of having this supply demand balance that the World Gold Council, and it's valuable data, but it doesn't indicate where the price is going for me. So what I do is take a West-East framework in it. And it used to be the West that was always driving the price for many decades, actually, until early 2022. And that is when China took over. And I'm doing research right now. I'm writing an article, will probably be released tomorrow or the day after. And so we know the People's Bank of China, by their official numbers, bought a lot of gold since early 2022. But they're buying far more than they report. I also wrote about this, and you can get these numbers from comparing the World Gold Council. Every quarter, they release an estimate based on field research, how much central banks in aggregate buy. So they come out with a number, for example, in 2022, it was 1,000 tons or something. Then you go to the IMF and you look what they officially report, and it's a lot lower. So, you know, the field research reveals that there is a lot more buying than what they officially report. And some sources have revealed to me, two of them, that difference, you know, the secret buying is mostly the People's Bank of China. Now, I also found out that, long story short, what the UK exports to China is PBOC buying, because the UK only exports large bars. You know, there hardly are any small bars in the London bullion market. So what the UK exports to China is all large bars. Large bars are not being sold over the SGE, so that all goes to the People's Bank of China. Now, what the People's Bank of China did in May is they said, well, we stopped buying. But I see in the trade data, they didn't stop buying. So what they did is trying to cool off the market. You know, the Chinese have always been on what I just said. The West was driving the price. If the price was going up, the East was selling. If the price was going down, the East was buying. They were always, you know, very price sensitive, the East. Now they're in need to buy more gold because of, you know, geopolitical reasons, but they still like a low price. Of course, this is natural, right? So they communicated to the market, we stopped buying gold in May, but they continue to buy gold. So what that mainly says is they provide, first of all, you just want to cool off the market and get more gold for their dollars, but also they provide a very solid floor underneath the gold price. And what we see now in the last couple of weeks, based on your data, is that ETFs are picking up again. So the West is joining the bull market now. So it's going to be, you know, maybe East and West are going to be buying and driving the price of gold. We already see that a lot of Asian consumers are stepping out. You know, obviously, they always have been price sensitive. So but the central banks in China, in Thailand, in other countries, they have to continue buying because they just have too little gold relative to their dollar holdings. So that makes me really bullish. Long story short.
Good, thanks, Jan. And you are the expert on this subject. And you know, this is the official data, and what Jan's saying is there's a whole load more unofficial buying. And just to highlight, you know, China's big buying a little bit back here when no one had heard of the PBOC. But then in 2008, they bought quite a lot on a gold dip. They did the same in 2015 on a big gold dip, and they did the same again in 2021-22. And so they have been very good value buyers. And that's one of the most amazing things about the gold market. There's always someone who wants to buy gold when the price is low. And that's why the volatility is so low. So it's a very special asset in that sense. And that's the world central bank's total gold holdings. You know, they were falling all the way from 1980 down to 2008, and then and this is the best bit, I think. And yeah, I'm sure you'll agree with me. There's no document anywhere telling central banks to own gold. They just decided to do it. Now, there was one pre-1970. There was plenty of documents. That was how the world financial system operated. But they just came to the conclusion naturally post-2009 and started to accumulate gold, and they continue to accumulate gold.
Yeah. Yeah, and I think that's because of what I said in the beginning, also because of the balance between credit assets and money without counterparty risk. And if, you know, if that balance is out of balance, it naturally, organically, you know, by too much debt, too much credit instruments, it will go back to the historic average. So gold has a long way to go, I think.
Good man. So I'm going to just go through the ByteTree data. This is on the bold.report website, which is where we host our Bitcoin and gold ETF flows and some other stuff as well. Going back to 2015, that blue line tells you the total number of ounces held by all the ETFs in the world. We've got ETFs now in India and in China and Thailand. So we really have gone out there to try and capture absolutely everything. And this is publicly available data. And the bottom line is basically green is inflow, the blue line is rising, and red is outflow, the blue line is falling. And so we've had a good burst recently, following 3 or 4 years of downturn for the gold investor demand in the West, as Jan says. And this is over the last months. Go on.
So do you think, because I also looked into this data, and I think that like 90 or 95% of ETFs are in the West, right?
Yeah.
Yeah. And you think they're going to continue buying now, like Western investors through ETFs?
Well, I think it depends. If the stock market wobbles, then they always, gold always becomes more popular. So, when the stock market's doing well and, all your investments in your portfolio are happy, then investors are pretty happy to be close to market. But the need for alternatives always increases when mainstream markets, bonds and equities, particularly equities, start wobbling. So, I think that if we get wobbles, then expect them to come to gold. I mean, just remember 2020, right? The middle of 2020, that was that gold surge was the last example we've had of that. And then also around the time of the Ukrainian invasion.
Yeah, and what do you think about the stock market? Are you bearish or bullish at the moment at, let's say, the S&P?
I think that I've been in the game long enough to know that you want to be bullish equities always. Just hope you've got the right ones. And I think that if you're going to own the FANGs and stuff and the highly priced stocks, they're potentially very dangerous. They can go down a long way. But if you stick to fundamental value and think of it, put your private equity hat on, then I don't think it's nearly as risky as the overall market. And so that's very much our philosophy here. But if you don't mind, this is a Bitcoin and gold webinar, so I could speak for hours on the stock market. So we better get back to our topic, because we want to talk about gold equities, which are good value. But before we go there, this is gold and silver, and the chart starts in 1995, and it's rebased to 100. And basically, gold and silver are, about the same sort of thing. Silver over all that time, gold slightly ahead. The gold-silver ratio, again, it's rebased in this situation, so it went up to 60% higher in 2020 in the COVID crash, and it's probably a bit more neutral now. But there was a huge surge in 2011 in the price of silver, and then it really dropped cheap rail gold in March 2020. And the hope is a catch-up trade. But yeah, and you got a slightly different view on silver, haven't you?
Yeah, well, I have my personal views. I'm not an economist. I've never worked at. I think you worked at large institutional banks and stuff, and have some particular schooling in this. And I just read books, whatever I like. And what I think about silver is that it has been a monetary metal for thousands of years, and what the role of silver has always been a medium of exchange, because it was cheaper, so it was easier to buy groceries with. So gold was a store of value, and silver was the medium of exchange. But nowadays, with technology, every medium of exchange, it's always digital, right? I mean, if it's backed by national currencies or bank deposits or gold or Bitcoin or however you pay, it's through plastic cards or smartphones and whatever. So we don't really need silver as a medium of exchange anymore, and thereby. At the end of the 19th century, silver started to become used for industries, photographic industries, etc. And at the moment, silver, the total above ground supply of silver is for 50% in industrial parts and for 50% in jewelry and silverware, and only a very small part of that above ground supply is in large bars in volts. So you already see that it's been industrialized for like 50%. So it's like 50% in industrial metal, 50% still let's say if we count the jewelry with it, it's a monetary metal. So, but what I think for the future is that it will be more and more and more of an industrial metal and less of a monetary metal. So I'm still bullish for silver in this, let's say, gold bull market, but I think further down the road, it will lose its monetary status and it will be just a commodity like copper.
So I think what you're saying is that the gold-silver ratio, in your opinion, is a long-term uptrend. Now, if you think that a gold-silver ratio today is, God, I should have checked before, it's about 85, something like that. And in the 16th century, it was 14, was it, or 17?
Yeah.
So it's, you know, it's that you're just saying that, you know, ever since Isaac Newton was at the Bank of England and they set the gold-silver ratio back then, and it's now 4 times higher, then that's just going to continue. I mean, I can't disagree with that, but I've always had a sort of sweet spot for silver as a good catch-up trade. But it has been a bit disappointing these last few years, notwithstanding the fact that we've got some silver in one of our portfolios, and it's done quite well. We had a good entry point, but
yeah,
you know, the hopes that it's going to make a new all-time high soon. You know, it's $30 and the all-time high is $50, you know, whereas gold's comfortably in all-time high territory. There's a different technical pull.
Yeah. And even, you know, if you go, it's maybe outside the scope of this webinar, but if you go back further to ancient Sumer, the gold-silver ratio was below 1. At first, silver was more expensive than gold. So if you draw a very long-term line, yes, it's going up.
And I think they recorded that on a blockchain, didn't they?
Yeah, exactly. No, on a clay tablet.
Yeah, you didn't take me seriously. Good. That was great.
That's a good job.
Going back 40 years, we'll now look at the gold price against the gold miners stocks, and this is the Philadelphia Gold and Silver Index. And you know, it's quite a spread, isn't it? You know, it starts at 100, and then you've made 69% over 40 years in gold stocks, plus dividends, of course, whereas gold's really done something far more spectacular. And so that is, you know, it says it all, that red line just going down and down and down. But I'll flip to the next slide because the last 10 years have seen a better picture. You know, I think that low point in the gold market in 2015 was the low point, not just in price for the gold stocks, but the relative price to gold. We had another test of that in March 2020, in the COVID pandemic crash. And then we had one earlier this year. And it just strikes me that, you know, the lack of sentiment, you know, we've covered that. We've covered the structural demand. We've looked at the change in the macro situation, the Western flows sort of coming back a bit. You add it all together, and gold stocks are pretty unloved, but they're starting to see some good strength. And what do you think of this, Jan? Gold miners.
Well, I think they reached the bottom. I look at a different index, but anyway, it doesn't matter. I think there's great value in some of the miners, also because, you know, it's my job to look at the gold price every day, and I think it's going to go up. So that's bullish for the miners as well. And if they have underperformed so long relative to gold, I think there's a lot of upside in them.
Good man. So then finally, that means we say, well, you know, what, given the choice of silver or the gold miners, then what do you want to choose? Now, it goes without saying, since silver has been so close over 40 years to gold, don't forget the late 90s, silver outperformed gold. So that was one of the reasons why it's had that. But the gold miners have done really, really badly because they've been poor operating business models, basically. There hasn't been enough margin between what the price they can sell gold at and the price they can mine it out of the ground. And the lower line shows you whether you know, who's outperforming, and it's silver relative to the gold miners. And again, you've got that kind of 2015 reversal when that was the time that silver had been peak good versus miners, and that line does seem to be somewhat in decline. So, you know, I think my conclusion, and I've written this in Atlas Pulse a couple of times, is that yeah, the gold miners should do better than silver. But I'm very comfortable holding both because, you know, they've got so much in common much of the time.
You even have miners that dig out of the ground both silver and gold. So, you know, might be interesting.
Oh, yeah. Okay. Well, they can mine all sorts of things. But I think it's just, you know, there's so much of an equity share, you know, an equity price. So much of it is sentiment. You know, fair value is 10. The price can be 5 or it can be 20 easily. and so there are other factors other than what the price should be. And
it's
then
so funny. I read the other day somebody on Twitter said fundamentals never matter for equities, and it's always about liquidity or whatever. And it's maybe he's true. He's right.
Wow. Well, he's certainly not right in the long run, because there are times when when fundamentals really do matter.
Yeah, sure.
Sometimes someone pulls the switch on the market and reality kicks in, which is very uncomfortable.
Yeah.
And this is our money map. What's interesting, we're going to touch on Bitcoin just to the end, 2 slides. And obviously the ByteTree bold index has gold and Bitcoin in it. And what's interesting is these are both monetary assets. Bitcoin is likes inflation, gold likes inflation. But my argument's always been that Bitcoin prefers a strong economy, whereas gold prefers a weak economy, which is one way of reflecting that, amongst others, is bond yields rising versus bond yields falling. And then the Western world, the developed world, that does really well when inflation is low, which is the expected normal state of affairs for a developed market. Hence, bonds and equities are good, strong assets. Whereas in the emerging markets, when inflation is structurally higher, bonds and equities don't do as well. Their bonds and their equities, and Bitcoin and gold do better. So the question is, if the Western world is becoming an emerging market, then you really need to own Bitcoin and gold. And the reason I put these two together is because they're naturally uncorrelated, and we're basically 3 to 1, 3 times more gold than Bitcoin. But you sort of rebalance every month, making sure you top up the one that's been weaker, and then over time you do really quite well. And so this chart has got, it's since the Bitcoin high in 2017. Some of you would have seen this. It's my favorite chart in the whole world. And the bold index is the blue one, which has basically done the same as Bitcoin in what, 6.5 years. And then we've got the lower group. We've got gold, silver, and gold miners, which are basically all in the same place over that period. And so, I put it to you that a very sensible way to own not just Bitcoin, but also gold, is to put them two together, to put Bitcoin and gold together and rebalance them on a periodic basis. What do you think of gold, Jan?
I think it's an excellent product. I mean, if you just look at this chart, I mean, it makes sense. There's a lot of, also in my mind, but I think in the market, a lot of thinking, guessing, and there are a lot of narratives about what Bitcoin is. Is it a store of value? Is it a tech asset? Whatever. But if you look at this chart, it doesn't really matter. It works, right? If you add it to gold, you get more upside, and yeah, it's an excellent product. I own a little bit myself. I got more in gold and Bitcoin itself, but yeah, I'm still wondering why. I think did you say this in the beginning of the webinar? It doesn't get a lot of attention. I'm really puzzled why.
Well, I think one of the reasons is that 90% of the world don't care about alternative assets like gold and Bitcoin and silver and gold miners. So it's a minority sport already. And then the Bitcoiners hate the gold people, and the gold people think the Bitcoiners are stupid. So the club that actually likes Bitcoin and gold is very, very small.
Yeah, that's true. It's a shame, though, that people are so short-sighted.
To my mind, a portfolio should have a decent slug of gold in it, and even a conservative portfolio that doesn't even like gold stuff. I mean, the Bank of England, the Bank of the Netherlands, all of these places own gold, and by the way, they all own Bitcoin as well, but through policing, because they keep confiscating it off all the criminals.
Really? Right. But that's then the Ministry of Finance, not the central bank.
Well, yeah, fine, but the governments, all of our governments hold Bitcoin now, and if you go through law enforcement circles, so they're all bold now, aren't they? So let's go on to Q&A, and hopefully we've got some questions. Although I haven't actually warned anyone. Normally when I'm good at this, I warn people, but we can just read out this question first, and this came in earlier today, which is very, very handy. The US presidential election is not far away. We have little idea what a Harris presidency would do, but clearly the accumulated deficits from the federal, state, local, and the other looming deficits such as pensions funds, what do they mean for the administration, whose hands are tied? Do they carry on before? Would rising bond yields boost the gold price in Bitcoin? Under a Trump-headed presidency, the most destabilizing policy, in my opinion, would be that which one tries to reduce the reserve role for the dollar, which might be good for gold and alternative assets, but would be enormously short-sighted. It would have far more impact than reducing the US military role in the world. Or might there be a growing aversion to turning away from the US dollar towards gold and alternative assets? There's so much to unpack there. Should we start the webinar?
Yeah. Sorry, yeah, it's a new webinar. Yeah. Well, first of all, I think it doesn't really matter. It doesn't really matter who wins the elections, because both have to spend like crazy. First of all, to pay interest rates. Trump has to spend a lot to buy votes. Basically, you know, the Midland is all that's his territory, and he has to spend to get their votes. So, and regarding bond yields, well, we just saw if yields goes up, that doesn't stop the gold price. So, you know, I don't want to. And I'm very curious. Maybe you want to answer this. Do you think that Trump will? He has this advisor, Judy Shelton. Sorry, my English is terrible today. She wants to create a level playing field. Do you think she wants to devalue the dollar and, like this person says, reduce the role of the dollar?
I don't know, but I do know that it's the easiest way to keep the party going, because it's, you know, if you're an aristocrat with a big house and a huge estate of land, and you know the money stops coming in from the family business or whatever, then you know we have the expression, you sell the silver, right? You sell the family silver. It's very appropriate for Bitcoin and gold webinar. And the simple way to do that for a country is just to devalue slowly. It's a very good way to, you know, hide all the other cracks. And of course, eventually you lose control of the situation and slowly becomes quickly. But it is a strategy, and I think that's the one area where the US has plenty of room, you know, to slowly devalue.
Certainly.
Because the dollar's riding pretty high right now. It's the one thing they've got that's right up there. And then, you know, you're devaluing the debt very, very easily. You're creating that monetary inflation. So, you know, they can do it. And I think it also takes much longer. You know, I've got a friend in Argentina who just says, you know, we got to remember it just takes much longer to destroy a country than you think. And you know, we all think that, you know, one bad policy decision or some general election or whatever is going to make a difference. It really doesn't. And I think the point you just made, it, you know, both either Harris or Trump, both of them like to spend money, I think, don't they? So, you know, is gold a Republican or a Democrat? It's neither. Bitcoin's not either. They're neutral forces. So, you know, they're just going to appreciate slowly and steadily if there's sort of more juice, more money in the system. Right. Let's see what the Q&A's got. If you have any good questions, then please send them in now. And why does it say there's a question, but I can't see it? Ah, there it is. Can you explain the relative merits of gold miners versus royalty companies versus streaming companies? Well, I think that the latter are the low risk ones in the food chain, and they're basically, it's the same. If you imagine a debt book of a company's debt book, then the senior debt pays a lower yield and has the least risk, and the junior debt pays a higher yield and has the most risk. I think it's just that. And so a normal gold miner that gets its hands dirty, as I wrote recently, digs a hole in the ground, very dirty hands, and makes the most money when their margin is improving in a strong gold price rising environment. And the royalty company cares less about the gold price because they're first in the queue, so everyone else takes pain before they do, but they never get their hands dirty, and it's very much a white collar gold mining job. And I would think that the high margin companies don't have room to increase their margins. So you end up with the royalty companies just matching the gold price. They should just look like the gold price, with obviously some risk if the gold price was suddenly to collapse a great deal. Whereas the operating companies have got that potential to go from low to high margin, and that journey is 10x more interesting. So I think that's the way I see it. Now, royalty companies and streaming companies, you got me. I don't actually know the difference, although I don't think they're that dissimilar. Certainly I'm sure the finance people will be in horror for me to say that, but I think from a investor's perspective, I think they have a pretty similar dynamic. Do you have anything to add to that, Jan?
Nope.
Okay, we have another question. Keep them rolling. Keep them rolling. From Mike, what's the relative impact of the BRICs on prices likely to be going forward, small, medium, or large? Okay, the BRICs and gold. Come on, Jan, this is your territory.
Yeah, well, first of all, I think there has been a lot of buzz around the BRICs, and the BRICs is really, I think the BRICs are bigger on Twitter than they are in reality. If you look at what they come out with officially, you know, for example, there has been news by the Russian, you know, by the Kremlin or some Russian politicians say, we want to create a currency for the BRICs. But there is no official documentation. So if you compare that to the euro, for example, they have been working on the euro for 30 years. A lot of research, a lot of reports. It was all in the open. Everything was studied. That's kind of a difference with this new BRICS currency, of which there is nothing yet. So you know, I wrote an article last year. You know, Jim Rickard said there's going to be a new BRICS currency backed by gold, and he was 99.99% certain it was going to be launched in August. And I said, well, I don't think so, because there's just, you know, every lead, you know, there was for example, an Russian embassy in Kenya that posted a tweet that was based on fake news and blah, blah, blah. And everything went viral. And I said, well, I don't think so. And of course, nothing happened because, you know, they don't have a lot. They haven't done a lot of work on it. Also, the BRICS countries don't have a lot of things they share, like democracy or religion or other values. So they could become very powerful, but not yet. And I'm more interested in, for example, projects like Enbridge. Enbridge has, you know, there are working groups. They produce reports. There is a minimum viable product now. You know, Enbridge could really change how BRICS countries, but also other countries in Asia, how they can trade with each other without the use of dollar, and then settle imbalances in gold. That's an opportunity. I see that, you know, the whole Enbridge path. I find that more interesting than looking at the BRICS.
So the BRICS acronym was created by Jim O'Neill from Goldman Sachs in 2001. And I went to a talk that he spoke at fairly recently. Ironically, I took Dominic Frisby as my guest,
Wow.
who didn't like it. He said, God, what a terrible bloke, he said. But I rather like Jim. I think he's quite impressive. And he's now a Lord. He sits in the House of Lords. I think he's on the board of Manchester United. But he wore a suit and trainers, and he's in his 60s. So I thought, you know, the world really is changing, isn't it? But I think the point he made about the BRICS currency, which I thought was quite funny, was that, you know, these guys can never agree on anything with each other. So, you know, yeah. And could you imagine, you know, you put money into some BRICS currency, and then you go to redeem it in Russia or China, you know, or something like that. And I mean, it's just not plausible, is it?
So, no, I don't really think so. They could use some kind of new currency backed by gold, but then what's the new currency? It's just gold. They're just going to use gold, right? It hardly needs an infrastructure. It just needs to have a couple of volts and some clearance every now and then.
Thanks, yeah. So, okay, this is a question. I don't really understand this. It's an asteroid, right? This is the whole joke about what's that metal, the high density metal?
About asteroid mining.
Yeah, asteroid mining. So there's a big asteroid coming to Earth full of nickel and gold and that sort of thing. I mean, you know, it's hardly bullish for gold, is it? But I should think it would blow the world up, wouldn't it? Or is it just sort of
no, I don't think it's not heading for Earth, but it's if it, you know, comes close, we could mine it, right? That's what the question is about, right?
Is it going to, you know, it's going to damage the stock to flow ratio of these monetary metals?
Yeah, well, then you have to think about how are they going to mine precious metals or other metals on the asteroid? right? I mean, we can barely go there with one person, let alone with mining equipment and etc. Okay, suppose then we can go there with mining equipment and all sorts of, how do we get it back to Earth? Well, some people say, yeah, we're going to use a laser there and we're going to cut blocks from the precious metals.
Yeah.
And then,
yeah, and if you're going to answer this question, you're going to pretend you're Elon Musk, okay? And
yeah, okay, I will. Yeah. Well, first of all, suppose Elon Musk will succeed in bringing the gold back. The moment the gold is back, it's worth nothing. Okay, so I don't think he has an incentive to go there. Second, if you bring it back, you can only bring it back if you tow it through space, right? You can't put all the gold in a rocket. So then you're gonna just put it in the atmosphere, and it's gonna blow in a million pieces and become liquid or something through the temperature and fall into the ocean. Happy mining in the ocean. So I thought about it. I don't think it's going to be happening anytime soon, this asteroid mining. Maybe in 50 or 100 years with technology I can't think of. But with anything we have now, it's going to be very hard, let alone iron or nickel or copper.
Well, so if we don't go back to the Stone Age, it's a real risk in 50 or 100 years. It's a tiny risk in 50 to 100 years if we don't go back to the Stone Age in the meantime. Okay, so I think that that's not serious, but I do understand that some people worry about asteroids.
Yeah, you have to talk about it. Just
no,
like
yeah.
they can make fake gold, in an damn, my English is so bad today. In a collider, they can create gold, but it's just one molecule and it's radioactive. So it costs like 5 billion to create one gold molecule that's radioactive. It's not worth it. And
we should launch an ETF. It sounds like a good idea.
yeah.
Okay, from Chris, do you follow the land business cycle? If so, do you concur that we are in the last leg up before a large correction around 2026? How would you position based on this? The land business cycle, is that a Akhil Patel thing? I have to say, I haven't read his work, so forgive me, I don't really know what that is. And in the last up leg, I don't know. But 2026, if this bull market could carry on for a couple more years, yeah, why not? Quite possible. I mean, but there are lots of reasons it could end earlier. Okay, from Marcus, who is in control of the gold price in your opinion? Jan, you're listening. Who's in control of the gold price?
Yeah, well, at the moment, it's really much the East and the People's Bank of China. It depends on what your time frame is. If you look at today, I don't really know, right? But trade data from China and the UK and Switzerland and ETF flows and everything, the stuff that I look at goes back like 2 months ago. So there's a bit of a lag. And it's China. China has been driving the price of gold since March, April of 2022. And that has created this gap between real rates and the price of gold. But now, like we just said earlier in the webinar, it's going to be probably China, the People's Bank of China, and the West also, because rates cut are coming nearer and nearer.
Okay, thanks. Yeah. So the next question is, for those with paternalistic brokers who exclude bold, have you considered gold miners and Bitcoin miners products? Of course, they might protect us from that too. Well, I mean, of course, not everyone's excluded. Jan can buy gold in Amsterdam, and so can most people in Europe. But the idea there is that the miners are crazy compared to the underlying. So the volatility of gold miners is basically the same as Bitcoin. And the volatility of gold is really nothing. It's down in the sort of 12, 13, 14% range. And if you just put the gold miners and the Bitcoin miners together, you just could put, and the Bitcoin miners are, they're sort of 80, 90%. They're like MicroStrategy. They've got huge volatility. I mean, you're going to have this sort of crazy outcome. And I just don't think that's the point of it. Gold was supposed to be a sort of very calm way to gently add a little bit of Bitcoin to your gold, and that will serve you well over the long term. That was all it was, to manage the risk and to get the upside from the rebalancing. I think if you put two really high volatility assets together, which are batshit crazy, both of them, then particularly the Bitcoin miners, then you're just not going to get an outcome that would make sense. And the Bitcoin miners, I think they're funny old business models. I mean, we wrote about them today in Atomic. If you look it up, ByteTree's Atomic, there's a small mention, which actually Laura wrote that piece. I've never covered them because I never really understood them. Something strange. There's something strange about the Bitcoin mining business model. The noise around the petrodollar's demise, is this a reality medium term?
No, I think it's, I do think that eventually and we see this happening, the relevance of the dollar is declining, but very slowly. Also because you have the euro dollar system, and basically, very large parts of the world trade with the dollar and still use the dollar to buy treasuries, and they hold treasuries, etc. This whole infrastructure of the financial system is not going to change overnight, and also not in the medium term.
And also, there's no one to really take over from the dollar at this moment in time. Where is the main force for setting the gold price? London, Shanghai, New York. How's it shifting? I think we've covered this one.
Yeah.
We have, yeah. But yeah, is the price arbitrage between different locations given the physical chance of moving gold? I mean, they move gold every day. It's a live business model. But yeah, the gold goes from west to east. It doesn't come this way. From James, Hugh Hendry recently suggested the total gold market as a percent of global GDP is high based on a historic basis and is therefore not overly bullish. Hopefully I've understood this correctly. Any comments? The gold market, $15 trillion as a percent of global GDP is high. I can't buy that.
I don't think so.
No, it sounds wrong. I mean, I have to go and check it for the next issue, but of Atlas Past, but it doesn't strike me as correct.
I think GDP also is somewhat correlated to M2, so you might as well get your M2 global M2 to all gold ratio with that, and we kind of covered that.
So, and I think also, Hugh, when he said global GDP, he must have meant global nominal GDP, not
yeah,
real
of course.
GDP. Yeah.
I hope so. Yeah.
Yeah, which would be similar to M2 as a chart we showed earlier. It's a little bit over the historic average of the last 20 years. Still a little bit under on the US basis. But what we're saying is we're about to see a pickup in nominal GDP because that's what money printing does.
Yeah, maybe I want to add that you showed a chart of MT relative to gold, but what is money nowadays? For some institutions, treasuries are money. So, you can use M2, but you can also use global financial assets. And if you look back, let's say 100 years at global financial assets relative to gold, gold is very much undervalued.
Particularly against financial assets, yeah. So in the UK, Bitcoin is legal but virtually impossible to buy. And if you buy it and then sell it, UK banks won't accept the funds. Will this change? And what does it tell you about the government attitudes to Bitcoin? Oh gosh, I mean, it's just been the bane of my life trying to build the company, the ByteTree holding company is called Crypto Composite, and we tried to build a data business for Bitcoin here, and it's been a nightmare because it's just been such a difficult place, and mainly because the people we thought would be our clients, which were financial institutions, just have never engaged. So it's been extraordinary. So we've had to swivel and do something completely different. I mean, one hopes the rules will change, and I think the more credible Bitcoin gets, the harder it gets to deny that it's a real big deal. And that's the sort of simple defense it has. And so these US ETF launches are now on Ethereum as of yesterday, which is great. So it just means that there's more happening elsewhere, and it just makes us look more and more isolated, which means we're wrong. And so hopefully the UK will allow crypto into the system. Technically, you can buy, if you're an institutional investor, you can buy a London listed Bitcoin ETF or Ethereum ETF. But I mean, what's the point? It's supposed to be a retail asset, and so the whole world can own it. Because of course, if you're an institutional investor, let's say you run a large fund at a large fund management firm, if your underlying clients are retail, then you can't buy Bitcoin. So actually, no one can really buy it apart from family offices, because the underlying clients are our wealthy people and that sort of thing. So I think that it's all a bit of a strange situation over here. I really hope it changes, and that's why I built Bold, really, to put it into portfolios mainstream. Always grateful for those who have supported our product, which one day
I do.
Thank you, Jan. So I think we've come to the end there. Any final thoughts, Jan?
No, not really. I put everything in there actually about what I'm working on, thinking about, and about what we discussed.
So can you go fishing now at the beach that's just down the road?
Yeah, I will.
And can you put a picture on that? Well, we'll share a picture in my next issue.
Yeah, will do.
Yeah, and thank you very much for joining me, ladies and gentlemen. Thank you very much for joining us, and wishing you a happy summer.
Thanks, Charlie.